Welcome to this lesson on free cash flow, a fundamental concept in corporate finance. Free cash flow represents the money available after operations, and it helps us understand the actual cash generated that's available for investors. This metric is crucial for evaluating a company's financial performance and its ability to create value for shareholders. Free cash flow is defined as the cash generated from operations after paying for capital expenditures needed to maintain and grow the business. In simple terms, it's the leftover cash a company has after covering all the costs required to keep the business running and expanding. This is the cash that can be used for various strategic purposes. The formula for free cash flow is straightforward. Take the operating cash flow and subtract capital expenditures, and the result equals free cash flow. Operating cash flow minus capital expenditures equals free cash flow. This simple calculation gives us a powerful insight into a company's financial health and its ability to generate cash beyond basic operational needs. Operating cash flow is the cash generated from core business operations. It represents the money flowing into the company from its day-to-day activities like selling products or providing services. You can find this figure on the cash flow statement under operating activities. It's the first component we need to calculate free cash flow. Capital expenditures, commonly abbreviated as CapEx, refers to money spent on physical assets to maintain or expand operations. These are investments in long-term assets like equipment, buildings, and vehicles. These expenditures are necessary for the company to continue operating efficiently and to support future growth. CapEx is subtracted from operating cash flow because this money is required to sustain the business. Free cash flow matters for several important reasons. First, it shows the real cash available for investors, not just accounting profits. Second, it indicates the company's financial health and sustainability. Third, it's a key metric for valuation when determining what a company is worth. Finally, it's considered a better measure than net income for assessing actual performance because it focuses on cash rather than accounting adjustments. Companies have multiple options for using their free cash flow. They can pay dividends to shareholders, buy back their own stock to increase shareholder value, pay down debt to strengthen the balance sheet, fund growth projects for future expansion, make acquisitions to grow through strategic purchases, or build cash reserves for future opportunities and economic uncertainties. How a company allocates its free cash flow reveals a lot about management's priorities and strategy. The key takeaway is this: free cash flow represents the actual cash a company generates that can be returned to investors or reinvested for growth. Unlike net income, which can be affected by accounting rules and non-cash items, free cash flow shows the real money available. Understanding free cash flow is essential for evaluating investment opportunities and assessing whether a company can sustain dividends, reduce debt, or fund future growth.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.